Hey everyone, Adam Simmons here from Dgtl Infra, short for digital infrastructure. We have been discussing much of the investment thesis behind digital infrastructure over our past videos. But likewise, there are investors, particularly hedge funds, who are making bets against the digital infrastructure sector. A lot can be learned about which publicly traded digital infrastructure stocks investors are betting against in greater or lesser amounts on a proportional basis. In this video, I'm going to give you a quick overview of the short interest as a percentage of the float in 19 of the most followed digital infrastructure stocks that trade on the United States indices. Additionally, we'll look at a comparison of the key changes between current short interest and short interest 1 year ago, and finally discuss the possible rationale as to why certain stocks may be shorted more than others. You might actually be able to make some money or save some money by understanding where investors, particularly hedge funds, are placing their short positions. So stay tuned and I will break this all down for you. Before I do, be sure to subscribe to the Dgtl Infra channel and turn on the notifications so you don't miss my next in-depth video that is coming out soon. Now, let's jump into the video. So we'll start with discussing the first sector of digital infrastructure, being towers. And as we know from prior videos, tower companies enjoy stable business models, characterized by things like recurring revenue, rental escalators, which are typically 3% in the United States, long-term contracts, think initial term of 5 to 10 years, high operating leverage, low maintenance capital expenditures, and leases to strong investment-grade tenants like AT&T, Verizon, and T-Mobile. In summary, the tower business model is less complex and has been easier for investors to understand, positioning it on the low-risk end of the spectrum. Given the strength and durability of the tower business model, it has created limited volatility for investors from an earnings perspective. Therefore, towers represent a very small short position for investors overall, as compared to other sectors of digital infrastructure, which we'll get into next. So American Tower, which trades under the ticker AMT, had its short interest as a percentage of the float decrease from 0.9% to 0.8% over the past year. So nothing material to highlight here. Crown Castle, which trades under the ticker CCI, had its short interest as a percentage of the float decrease as well from 1.4% to 1.1% over the past year. Again, no material change to highlight. And finally, SBA Communications, which trades under the ticker SBAC, had its short interest as a percentage of the float decrease again from 1.5% to 1% over the past year. Slightly bigger decrease, but again, not very material compared to what we'll see next. So now data centers, and we'll break data centers into two parts, those headquartered in the United States and those headquartered in China. And we'll start with the main data centers headquartered in the United States, where we can see a number of different business models and varying levels of short interest. So first is Equinix, which is the largest data center operator globally, and the company trades under the ticker EQIX. Equinix had a short interest as a percentage of its float decrease from 1.2% to 1.1% over the past year. So overall, Equinix has continued to execute in its growing scaled business with its strong ecosystem at low leverage levels. Equinix is generally considered a consensus long for many investors, and thus short interest has remained low relative to other data center peers. And in terms of the change in short interest year over year, it's not material. Next is the second largest data center operator, Digital Realty, which trades under the ticker DLR. Digital Realty's short interest as a percentage of its float has decreased from 8% to 2.8% over the past year, so a meaningful decrease. Some of the possibilities for this decrease could be attributed to the fact that Digital Realty has now closed its $8.5 billion acquisition of European data center provider Interaction in March 2020. In recent quarters, Digital Realty has generated strong leasing volume to the point where it really does not have any more inventory to lease to customers, especially in key markets like Northern Virginia. So given these positive data points, perhaps that is some of the rationale as to why Digital Realty's short interest has decreased so meaningfully over the past year. Moving next to CyrusOne, which trades under the ticker CONE. CyrusOne has a short interest as a percentage of its float, which has increased from 3.1% to 6.6% over the past year. CyrusOne really has experienced significant management turnover in 2020, which has given investors some concern, with the company installing a new chief executive officer in July 2020, a new chief operating officer in October 2020, and a new chief financial officer in October 2020 as well. So some of this management churn could have contributed to the 3.5% increase in CyrusOne's short interest over the past year. Next is Iron Mountain, which trades under the ticker IRM. Iron Mountain's short interest as a percentage of the float has increased from 14.5% to 18.9% over the past year. Iron Mountain is a bit of a unique company in the data center space because its data center business only makes up a portion of its revenue. Iron Mountain derives most of its revenue from rental fees for the storage of physical records, meaning paper documents and computer backup tapes. So Iron Mountain is experiencing significant secular risk towards the digitization of records and the shift away from physical storage, which is putting pressure on that aspect of its business. But the reason why we're including Iron Mountain in the digital infrastructure company landscape is because the company operates 14 data centers across 13 global markets with total power capacity of 122 megawatts. So in summary, the rationale perhaps behind Iron Mountain's short interest increasing is investors' focus on the legacy business, which focuses on the storage of physical records, which is in secular decline. Next is CoreSite Realty, which trades under the ticker COR. CoreSite's short interest as a percentage of its float has decreased from 4.1% to 1.5% over the past year. And this could really be attributable to a number of reasons. First, CoreSite is increasingly being appreciated by investors because it has difficult to replicate assets which are located in high-demand Tier 1 locations across the United States. Investors have also grown more comfortable with CoreSite's large customer churn events in 2020 and 2021, which include 9 megawatts in one of its Santa Clara, California data center facilities. And finally, CoreSite has also underperformed its data center peers over the past 12 months in terms of relative stock price performance, and thus investors may believe that the company does not have significantly further downside, hence its declining short interest over the past year. Next is QTS Realty Trust, which trades under the ticker QTS. QTS's short interest as a percentage of the float has increased from 10.5% to 14.2% over the past year. Although QTS has above-average growth in its data center capacity and significantly higher lease-up growth relative to its peers, investors have become increasingly concerned about QTS's ability to grow per-share figures, specifically its operating funds from operations per share, or OFFO per share. And second, a point that is interrelated to that per-share metric point is that QTS has experienced a sustained elevated level of capital expenditures to build out new data center facilities, which investors expect will require incremental equity raises and thus further dilution from a per-share metric perspective. So in summary, these reasons can be attributed in part to why QTS's short interest as a percentage of its float has increased by 3.7% over the past year. The final company in the United States data center landscape that we'll speak about is Switch Inc., which trades under the ticker SWCH. Switch is the smallest data center company that we'll speak about in the US and has a short interest as a percentage of its float, which has decreased from 16.2% to 6% over the past year. The theme behind Switch is that it has significant revenue concentration concerns that have lessened over the past year. So Switch generates significant revenue from data centers that are located at its core campus in Las Vegas, Nevada, which comprised approximately 89% of the company's revenue during 2019, and investors consider that if there is a significant disruption to this location, it could materially affect the company's business. An example being a catastrophic event or a prolonged disruption in this region. But Switch is also bringing online data centers in Grand Rapids, Michigan, and Reno, Nevada, which opened in 2016, and as both locations' developments continue, the revenue will help offset some of the concentration from the Las Vegas facility. As a result of this, investors have become more constructive on the revenue concentration decreasing over time, and thus short interest has materially declined by 10.2% over the past year. So next we'll speak about data center operators that are headquartered in China, but still trade on the United States indices through an ADR format. So first is GDS Holdings, which trades under the ticker GDS. GDS's short interest as a percentage of its float has decreased from 21.7% to 12.2% over the past year. Although GDS has seen its short interest decrease by 9.5% over the past year, which is a considerable amount, its short interest as a percentage of the float remains high at 12%. I'll highlight that GDS is known to have been shorted by a number of different hedge funds, including short seller Blue Orca Capital, who has written extensively about the company. I'll link to it in the description if you're interested in reading more. Some of the key points from the short seller perspective have been GDS potentially inflating the purchase price of undisclosed related party acquisitions and not having enough true earnings to support its debt load. Next is 21 Vianet Group, which trades under the ticker VNET. 21 Vianet's short interest as a percentage of its float has increased from 0.6% to 2.6% over the past year. So 2% is not particularly a meaningful change, and thus we'll move on and talk about other companies. So in the fiber sector, there is a wide variance of short interest between the companies and also a variance in business models, with some companies focusing more on wholesale dark fiber, others focusing on enterprise fiber, both of those businesses being in the business-to-business fiber segment, and then some companies focusing as well on the business-to-consumer aspects of the fiber segment, which include fiber-to-the-home deployments. Additionally, many of these companies are significantly levered, which has added to the pressure on the share prices of these companies over the past year. So first we'll start with Lumen Technologies, which trades under the ticker LUMN and is formerly known as CenturyLink. The short interest for Lumen as a percentage of its float has decreased from 11.5% to 10.2% over the past year. Part of the reason for this is that Lumen's more than 10% dividend yield acts as a floor to the stock's valuation, given that near term the dividend is secure based on the free cash flow generation of the company, even with some of the COVID-19 related headwinds that the company is experiencing. So investors do have a large short position against this company at 10.2%, but they've been reducing that short position based on the perceived risk-reward of that short position as the stock has continued to trend down in 2020. Next is Cogent Communications, which trades under the ticker CCOI. Short interest as a percentage of the float has decreased from 5% to 2.1% over the past year. And this can be partially attributed to the fact that Cogent has significantly underperformed its fiber peers over the past 12 months, and thus investors may believe that the company does not have significantly further downside. For example, part of Cogent's business is tied to providing internet service to multi-tenant office buildings, which has put pressure on the company lately as people and companies are not working from the office as much. Given that this trend may reverse, albeit slowly, investors have reduced their short exposure to the company, particularly over the past 6 months. Next is Unity Group, which trades under the ticker UNIT. Short interest as a percentage of the float for Unity has decreased from 12.9% to 6.6% over the past year, so a meaningful 6.3% decrease. And this can largely be attributed to the fact that in September 2020, Unity's largest customer, Windstream Holdings, which represented 65% of Unity's 2019 revenue and 84% of Unity's 2019 EBITDA, that company, Windstream, emerged from Chapter 11 bankruptcy in September 2020. So following Windstream's emergence from bankruptcy, Fitch upgraded Unity's credit rating to B+ from CCC, so a positive movement there. Hence, we can see investors reducing their short position against Unity's stock as the risk of its largest customer going bankrupt has receded. Next is a company called Consolidated Communications, which trades under the ticker CNSL. Consolidated's short interest as a percentage of its float has decreased from 15.7% to 8% over the past year, so a meaningful 7.7% decrease. A significant portion of this can be attributed to the fact that in October 2020, Consolidated Communications entered into an agreement with Searchlight Capital Partners, who will make a strategic $425 million investment in the company. So Searchlight's investment allows Consolidated to upgrade 1 million homes with fiber passings, but importantly, upon closing of the investment, Consolidated was able to raise $2.25 billion in new secured debt and retire its old $2 billion debt, which was previously outstanding. By being able to raise the new debt, Consolidated was able to push out the maturities of its debt and thus reduce the risk significantly that the company could go bankrupt. Because of these developments, the company's short interest has declined materially by 7.7% over the past year. If you're interested in learning more about Consolidated, we made a video called Why Fiber Investors Are Bringing You Gigabit Internet, which I'll link to now above and then below in the description of this video. Next is GTT Communications, which trades under the ticker GTT. GTT's short interest as a percentage of the float has increased from 41.8% to 45.5% over the past year, so an increase of 3.7%. But what's really meaningful with GTT is that half of its float outstanding is shorted by investors. And when short interest gets to these significant levels, it becomes very expensive for the likes of hedge funds and other investors to borrow the shares of this company. So they must really have conviction of their view, especially with the company's market cap being around $200 million. GTT's short interest is highest among the digital infrastructure stocks covered in this video. And GTT is known to have been shorted by a number of different hedge funds, including short seller Wolfpack Research, who has written extensively about the company, which I'll link to in the description below. In addition to its operational struggles, GTT has also experienced excessive management turnover, disclosed an accounting review, and delayed its earnings releases to investors for Q2 and Q3 2020. And these are only some of the recent problems which the company has faced. So finally, we'll talk about two more companies in the digital infrastructure space. One, Colony Capital, being a private equity firm that focuses on all four segments of the digital infrastructure landscape, and Boingo Wireless, which really focuses on small cells and distributed antenna systems. So first, Colony Capital trades under the ticker CLNY. Colony's short interest as a percentage of its float has increased from 2.1% to 10.6% over the past year. This can be largely attributed to investors having some skepticism over Colony's desire for accelerated disposition of its legacy real estate assets, such as hospitality, healthcare, and other equity and debt, and Colony's desire to shift its focus to its digital infrastructure investing business focused on towers, data centers, fiber, and the combination of small cells and distributed antenna systems. If you want to learn more about Colony Capital, I'll link above and in the description below to a video we made called Colony Capital, Mark Ganzi, and Digital Infrastructure. So in summary with Colony Capital, its short interest as a percentage of the float has increased by 8.5% over the past year, and we'll see if investors are right or wrong as the company continues to transform its business over the next 12 months. And finally is Boingo Wireless, which trades under the ticker WIFI. Boingo's short interest as a percentage of its float has decreased from 11.6% to 7.6% over the past year. This can partially be attributed to the fact that Boingo has significantly underperformed its digital infrastructure peers over the past 12 months, and thus investors may believe that the company does not have significantly further downside. For example, large portions of Boingo's business are tied to providing distributed antenna systems within stadiums and airports, which are both underutilized at this moment in time. And also, the company does have some exposure to the advertising segment. So hopefully you found this video helpful. If you did, then please share it with somebody you think might also find it helpful. And consider subscribing to DgTl Infra and visit us at dgtlinfra.com for more of the latest news on digital infrastructure. Thank you for watching this video. Be sure to like the video and post in the comments telling me which companies you think investors are underestimating the value of based on their short interest in the company. Thanks again for watching, and I will see you in the next video.